Hi, Tasty Nation and Investor Nation. Today I'm going to talk about contango versus backwardation in the futures markets. Now, even if you're not a futures trader, this video could still be important to you if you've ever traded an ETF that's tied to a futures product, such as BITO, VXX, UVXY, USO, UNG, or any of the others. So if you trade any of those, it's really good to understand how the futures products can affect the price of your underlying ETF. Okay, I'm going to start with /VX, which is the volatility index futures. And you can see that if we look out in time between right now into 2022, the different futures contracts are plotted here on what's called the product depth chart. So this is Thinkorswim, also known as TOS. I only use this platform for a few things, and I don't do any trading here because they don't even have futures available for Canadians. Okay, so here's a chart of the VXX prices right now in all these various months of expiration. The next expiration shown on this chart here is December 2021. The volatility is trading at 20.65. And then if you look to the next expiration, which is January, the volatility index is trading at 21.98. And then the next month, February, is 23.08, and it keeps going up and up and so on into the future, out into 2022. So this is what we call a contango. This is the normal look of this graph for volatility. So the price is going up and up for each successive month over time. That's what we call contango. The farther outdated prices are trading higher than the closer dated prices. And another way of saying that is the back month is trading higher than the front month. So that's contango. Okay, so here's a graph of /VX, the volatility futures. And this is just showing over the course of the last week or so, that is the futures price of the front month contract. Next down here, I have VXX, which is the ETF that tracks volatility futures. You can see the graph actually looks very similar. There's a very, very strong correlation between VXX and /VX. They're basically the same product, except VXX is an ETF and /VX is the futures. So this VXX is, I think, is a one-time leverage, and UVXY, I think, is like a 1.5 leveraged product. So anyway, you would expect a bigger move each day on UVXY than VXX. But both graphs look pretty similar to /VX. Okay, so if we go back to the product depth chart, what happens when time ticks by and the volatility price is increasing for each successive futures contract? What happens to the ETF prices? Well, these ETFs are made up of a bundle of different quantities of futures products that need to get rolled from the front month to the back month as time ticks by. So that causes drag on VXX and UVXY. And if I zoom out in time here, the trend in VXX you can see is clearly down over time. And part of that is due to that drag. And the same thing with UVXY. It goes down over time due to the drag of having to roll futures from the front month to the back month. So you're losing about 1.5% each month or something like that, just due to this constant rolling. And it's not just once a month that this happens, from my understanding. They do a certain portion of the account rolling from one month to the next month every day throughout the month. And then by the end of the month, they're fully in the back month futures contracts. Okay, so the next example I wanted to give here was for oil, /CL. That's the futures contract for crude oil. And then USO is the ETF that's supposed to track that. So you can see that the oil futures product depth has the opposite shape than the one I just showed you for volatility futures. This is what we call backwardation. So each successive futures contract, oil has a contract every single month. So if you go from the December futures contract trading at 80.69 to the next contract is 79.53 in January, and then in February, 78.26. And in March, 77.02, and so on and so on. And you can see there's what we call a backwardation in the curve here. So this is the opposite of contango. Backwardation is when the prices go down in the back month compared to the front month. So if you were to roll your futures contract from December to January or from January to March, the price you would be getting in the back month would be lower than the contract you're holding right now in the front month. So what would happen to our ETF USO? Well, in that case, over time, your ETF USO tracking that futures contract would actually gain about 1% or so per month. And that's just due to the rolling of the futures contracts. You would still add on any daily fluctuations that would happen in the oil price. Those would also affect USO. But then tied on top of that would be this rolling effect. This actually sort of helps you if you want to look at it that way. Okay, and my last example I'm going to give is Bitcoin. So Bitcoin futures / BTC. Here's the chart for that here. And the brand new ETF that tracks the price of the futures Bitcoin contract is BITO. BITO surprisingly already has options, so I've already started trading it. But let's look at the product depth for Bitcoin futures. So you can see right away, this is very similar to volatility where the prices are going up over time. This is Contango, so you can probably guess what's going to happen to the price of our ETF BITO over time. Well, it's going to lose about 1% or 1.5% per month, just like volatility futures. And that's just right now. So Bitcoin is trading in the front month, which is December, 58,300. In the next month, January, it's trading at 58,700. So it's quite a bit higher there, then a little bit higher in the following month, February, 59,000. So if you were to hold an ETF that tracks this over time, you would lose about 1.5% per month on average throughout the year. So by the end of the year, your ETF, if you were just to hold your BITO shares and not sell any options against them, regardless of what the price of Bitcoin does, you would actually still lose about 15% of the value of your shares per year. So as an example of that, if Bitcoin went up 30% in a year, you would only make 15% holding BITO. And if Bitcoin sits in the same place for a full year, I know that's kind of a wacky scenario, but if it did, BITO would still lose about 15% in that year. So that's the downside of using an ETF that tracks futures. If there was an ETF that tracked Bitcoin directly, the Bitcoin cash market, then it wouldn't have this drag. So you might want to hold something like that longer term instead of BITO. Currently, I don't know of any ETF that tracks Bitcoin directly, but maybe one will come. Okay, so that's backwardation and contango in the futures markets. So is there any potential solution to this issue of wanting to hold shares of these ETFs that may have drag over time? Well, actually, yes, you can use options to collect premium, and that can actually help fight against the drag caused by the ETFs. So in the case of BITO, I might just go ahead and sell a put rather than buy the shares outright. So if you haven't seen my video on how to trade crypto strategically, make sure you check that out because I talk all about this concept, how to reduce your cost basis over time. But I'll just show a really quick example here as well. Okay, so I'm in my IB trading platform now. This is the one that I use for all my trading because I'm in Canada. And there's no Tastyworks here yet, unfortunately. So here's a chart of BITO, the Bitcoin futures ETF. And here's the chart for MBT, which is the micro Bitcoin futures contract, which is 1/10 the size of a Bitcoin. So notice that IB doesn't use a / for futures. It's just MBT. So MBT has no options, but if I go back to BITO, you can see there's the options chain right there. Now, if I wanted to get long BITO, I'll go to 35 days to expiration, which is December 17th expiration. And BITO is trading at 41 right now, but I could sell a put down at the, say, 33 strikes. So sell the 33 put and get $1.10 credit for it, putting up $540 in buying power. So I'd be controlling 100 shares of BITO, putting up only $540, and the actual value of those shares would be 41 times 100 is $4,100. So I'm only putting up $540 for a $4,100 notional product. You're getting good bang for your buck there using a short put, and I'm collecting $1.10 in premium. So if I take $1.10 and divide it by the price that BITO is trading right now, which is 41.09, that's 2.6%. So if Bitcoin stays right here and BITO has that drag on it, I can actually overcome that drag by earning 2.6%. So even if the drag is 1.5%, I can well overcome that by gaining this 2.6% in that 35-day period. So this is one way that you can use to go long an ETF that has drag and try to overcome that drag. So it's the gain you get from premium selling that can help you overcome that. Now, the other thing I could have done instead of selling a put, I could sell a call against shares that I own, which is called selling a covered call. So if I wanted to collect something similar on the call side, maybe $1.10, I would sell the 18 Delta call at the 57 strike. And let's add on the stock here. Click the advanced button here, add stock leg. And there I have buy 100 shares of BITO and sell 157 call. Here's another way of looking at selling premium. You could use it to improve your cost basis over time. So even though BITO is trading at 41 right now, I can actually get filled on this transaction, buying the shares and selling the call all together for 39.9. So the trade-off here is you're putting up more buying power. I have to put up $2,700 to control those 100 shares, which have a notional value of 4,100. So I'm not putting up the full amount of the value of 100 shares. So I'm getting some leverage there, which helps me, but it's a lot more buying power I'm putting up than if I just sold the put. So if I go and look at the margin performance for this trade in its entirety, buying the 100 shares, selling the call, you can see I'm paying a debit of 38.9 times 100 is 38.90, which is less than the $4,100 of notional value that the shares have. And that's because of that premium I'm selling to help reduce the cost of it. So here's a way to buy shares of stock at a discount just by selling a call against them as you're buying them. So what's the trade-off you get for that? Well, now I've capped my max profit. The max profit I can make on this is only $16.95, and that's if BITO goes up over the next 35 days and hits my 57 strike and stays above it till expiration, I would get the max profit of $16.95. So if BITO went way higher than that, well, I wouldn't get that gain. So I've capped my gains by selling the call. But this is still a reasonable trade. My probability of profit is just a little over 50%. If I was just buying the shares, it would be slightly lower than that. But selling the call actually boosts my probability of success. And the max loss is 4,000. So that's if BITO goes to zero in the next 35 days. Okay, so that's one way to help overcome the drag that you would get from buying BITO, either selling a call against your shares or don't buy the shares at all and just sell a put. Okay, so that's Contango and backwardation. Thanks for watching. And please leave your comments below. I want to know, what ETFs do you like to trade? And tell me if you like to buy those shares outright, or do you like to use options to invest or trade in those products? And if you haven't seen my video on how to trade crypto strategically, make sure you check that out. And also, please let me know in the comments as well, how's my sound today? I had some requests in previous videos to try to improve my sound. So I got this new microphone. Hopefully it sounds good to the viewers. And if it does, I can use this in my future videos, which I promise to do many, many more of. Okay, thanks for watching.